Welcome to this lecture on financial management, where we'll explore the income statement. Also known as the profit and loss statement, it's a primary financial document used to evaluate a company's performance over a specific period. Its main purpose is to reveal whether a company was profitable during a given time frame, such as a month, quarter, or year. It provides crucial insights into how much revenue was earned, the costs incurred to generate that revenue, and the resulting profit or loss. The income statement follows a standard structure, beginning with revenue, which is the total income from selling goods or services. Next, we have cost of goods sold, representing the direct costs of producing those goods or services. Subtracting cost of goods sold from revenue gives us gross profit. Following this are operating expenses, which are indirect costs like salaries, rent, and marketing. When operating expenses are deducted from gross profit, we arrive at operating income, also known as earnings before interest and taxes. Below operating income, we account for interest expense, which is the cost of borrowed funds. After deducting interest, we get pre-tax income. Finally, we subtract taxes, which are income tax expenses, to arrive at the net income. Net income is the ultimate profit or loss for the period. This structured approach allows for a detailed analysis of a company's financial health and operational efficiency. Let's look at a simple example with ABC Bakery for 2024. They had revenues of $500,000 and cost of goods sold of $200,000, leading to a gross profit of $300,000. Their operating expenses were $180,000, resulting in an operating income of $120,000. After deducting interest expense of $10,000 and taxes of $33,000, ABC Bakery's net income for 2024 was $77,000. This example illustrates a single-step income statement, where all revenues and gains are grouped, followed by all expenses and losses, computing net income in one step. In contrast, a multi-step income statement separates operating and non-operating sections, allowing for a more detailed analysis of core operations. For instance, gross profit is calculated first, then operating income, and finally, net income. Using ABC Bakery's figures for a multi-step approach, gross profit was $300,000, operating income was $120,000, and after interest and taxes, net income remained $77,000. This format provides deeper insights into operational efficiency. From the income statement, we can derive key financial metrics. Gross margin, calculated as gross profit divided by revenue, indicates how much profit a company makes from each sale after accounting for direct costs. Operating margin, which is operating income divided by revenue, shows profitability from core operations before interest and taxes. Net profit margin, net income divided by revenue, reveals the percentage of revenue left after all expenses, including taxes. For ABC Bakery, the gross margin was 60%, operating margin was 24%, and net profit margin was 15.4%. These ratios are crucial indicators of profitability and operational efficiency. Non-operating items appear below operating income and include interest income or expense, gains or losses from investments, and one-time items like restructuring charges or asset sales. For example, if ABC Bakery sold an unused delivery van for $5,000 above its book value, that gain would appear below operating income, as it's not part of their core baking operations. Let's consider a simplified income statement for Apple Inc. for fiscal year 2024. Their revenue was $394.328 billion, with cost of goods sold at $223.546 billion, leading to a gross profit of $170.782 billion. After operating expenses of $54,914 million, their operating income was $115,868 million. Deducting interest expense of $4,300 million and taxes of $18 billion, Apple's net income was $93,568 million. In corporate finance, analysts use income statements to evaluate profitability trends, forecast future earnings, assess management efficiency, and compare performance against industry peers. For investors, it reveals whether a company is creating or destroying shareholder value. However, income statements have limitations. They use accrual accounting, meaning revenues and expenses may not reflect actual cash flow. Non-cash items like depreciation can distort profitability, and accounting choices can impact reported earnings. In summary, an income statement tells the story of a company's financial performance over time. It is crucial for investors, creditors, and managers alike, providing insights into how efficiently a firm converts resources into income. Combined with the balance sheet and cash flow statement, the income statement forms the foundation of comprehensive financial analysis and corporate valuation. Thank you for watching our lecture on financial management focusing on the income statement. See you at the next lecture.